If you are a homeowner and you're looking to buy a different house, you're likely dreading the idea of trying to coordinate listing your house for sale while at the same time trying to figure out a house to actually buy. After all, most people need the equity out of their current house to be used as a down payment for their new home purchase. But what if you could buy a house today even before you list your home for sale? No more rush decisions, no double moves, and no more temporary living situations that can drain your wallet and of course your time as well. In this video, I'm joined by a top mortgage advisor in the country to discuss two powerful financing strategies to help you buy your next house with confidence before you sell your current house. So if you're a homeowner looking to upgrade, relocate, or downsize, this could completely change the game for you. We're diving into dynamic solutions that are helping people just like you skip the stress and make a smooth transition and buy your next dream home. Stick around because these strategies might be the exact thing you need to move forward without moving out first. With that said, I have Jim Black, who's the founder of Revest Loans, to kind of talk about the options for people who want to buy a new house, but they already own a house right now. So thank you for joining us, Jim. Appreciate you.
Hey, thanks for having me on, Jason. Great to see you. Obviously, been a little while and looking forward to sharing some updates.
Yeah, it has been a while since you've been on the channel. So yeah, I guess like this is a common trend we've been seeing here that someone owns a house, but they want to buy a new home. Maybe it's in a different area. How do they actually do that? Do they have to get their house sold, move, rent for a while, and then buy a house? But there's other options obviously available for them as well. And so we talked about this the other day because I have a client who wants to move across the country, moving from the East Coast to the Sacramento area, and they have a house they own, and they're a young family. They're looking at options about how do they actually sell their house, then buy a new one. Do they sell first, then buy? What options do they have? So I want to bring you on today to kind of talk about options for people in that similar situation.
Absolutely. We know that a lot of people now that own homes, they have what's called an anchoring effect going on. So they have a couple of challenges when they're looking to try to make a move before they sell their house. We know that their current rates are probably a little bit lower than today's rates. And we also know that a lot of their equity is tied up for their down payment in their current property. So most people can't afford to have a two-property situation. A lot of people cannot afford to have a down payment that comes from somewhere else besides their equity. So fortunately, we have two approaches that are very popular that can help that family that you mentioned buy before they sell and have the right time to get top dollar for their house that they own, allow them to move comfortably and get settled into their new home, new community, new state maybe, and allow everyone to have a seamless transaction at a fraction of the cost of some of the other options that are out there.
Yeah. So can you kind of go over those options that people have? I mean, there's the obvious one, they sell their home, they move, they rent, and they buy a house, but maybe there's some other options that we can kind of talk about in today's video.
Absolutely. The first thing we want to think about in any of these situations is contingencies. A lot of times in transactions, when you're working with Jason, writing an offer, you can either have a contingent or non-contingent offer. Right now, having a non-contingent offer is very important because it allows the seller to feel comfortable that you're not having to wait for something else to happen before you can buy their house. So both the options I'm going to discuss.
Well, let's talk about like the contingent offer for people who may not know that term. That obviously means that you are writing an offer on a new property that is contingent on you selling your home first. That's what Jim means by a contingent offer.
Exactly. We know those are weaker because that means a seller is waiting for something else to happen before you're going to be able to close on their property that you're buying. So be aware of that. So
it's the bottom of the barrel of as far as offers go, right? Because they're saying, hey, I want to place this offer, I want to buy your house, but I have to sell my home first. But if your home is hasn't even been listed for sale, or even it's listed for sale and you have a buyer under contract, I mean, who knows if that buyer is actually going to move forward and buying the house? Maybe they have inspections, a loan approval process, appraisal, et cetera. So there's a lot more uncertainties in accepting an offer that's contingent on someone selling. So that's what Jim's kind of talking about right here.
Absolutely. So our two products we use, we like to call them contingency busters. And what those products are is the most expensive option that closes like all cash is a bridge loan, where we're able to do within the same state, do a cross-collateralized or a blanket loan on your current property and the new property. And what we do there is we look at the equity amongst both properties. So we take property value A for current house and the new proposed purchase, and we're able to do up to 75% of those combined values on all loans that are outstanding and available. So in that example, a bridge loan normally costs about 2% of the total loan amount you're getting, plus interest rates are 10 to 12% interest with an APR of probably closer to 13 to 15%. While they're short term, it's important to know they're a little more expensive, but they allow you to compete, kind of like on eBay. The buy it now button is very similar in that approach. If you want to buy something now, you push the bridge loan button, it will give you the strongest offer if you're competing on terms with other potential competition, or if the seller is willing to give you credits to close quicker. A bridge loan is very helpful in those situations. I will say,
well, can we talk about how that calculation, can you give us an example maybe about that?
Sure.
Because I think that you're looking at the value of your current home and then your potential purchase of your new home, multiplying that by 75%. Can you explain that again?
Absolutely. Let's say I have a property worth $500,000 and I'm looking to buy a property worth $500,000. All I do is take 500 plus 500, which equals $1 million. I multiply that by 75%, which says I can have a maximum outstanding balance of $750,000 in debt. So if I want to use a bridge loan to have 100% financing, I know that my current balance on my current house needs to be less than $250 in this example. So if I have a lot of equity, a bridge loan allows me to get 100% financing. I will still pay the closing costs out of escrow, but normally that's between 2 and 3%, which is similar to what the earnest money deposit is anyways. So that's the example that we always look at up front. If you don't have enough equity, let's say you're off by $50,000, you're more than welcome to bring that $50,000 in. Or we can even try sometimes to get credits from the seller to help offset some of those expenses. So either way you look at it, we're taking value A or current residence and proposed residence at 75%, and we're adding any current debt you have on your current residence into that equation.
Makes sense. Well, you're subtracting it, aren't you?
Yes, subtracting or adding, yes, whichever way you look at it. We know that your combined debt is 75%. So where this works really well is people that are moving down or downsizing works really well, because maybe they have $1 million house and they're going to a $500,000 house. We know that there's probably more equity in that $1 million house than the $500,000. So normally those numbers work really well when you're going down in value. When you're going more expensive, like maybe from 500 to $1.5 million, that's where normally bridge loans are not effective, because there's not enough equity to be able to leverage that. So you just have to look at your situational, scenario. And again, we're happy to explore that. That is the buy it now button bridge loan.
Makes sense. Okay, yeah. Awesome. And I guess the advantage there is that, hey, you can buy a home before you sell it, so you don't have to worry about two potential moves, like selling your home, moving, and then renting, buying a house, and then moving yet again. And then, of course, like you mentioned, it's kind of like a cash offer, right? There's no loan contingency. And also, is there appraisal contingency? There's not one either, right?
There normally is not. I just want to make sure that everyone's comfortable with the value of the properties. If it's some unique exotic property, we know that that's harder to sell. We may need the valuation on that. In addition to any of these options, to make sure that your viewers are aware, no matter what option we're talking about here, we have to make sure the borrower has the ability to repay whatever the end loan is. So we're not just jamming people into these loans. We're thinking 2 to 3 steps ahead to say, great, you can buy this right away. But more importantly, when your house sells, are you able to qualify for the debt? Are you comfortable with that payment? Are there strategies to make sure that you have the most optimal financing approach for the long run? So please know that's the most important thing we can do, is that I say no a lot of times, because if I can't get to that ability to repay and make sure we're thinking long-term for that client, then we're not going to do it. It's just not worth it, and I don't want to put people in harm's way.
Yeah, totally. All right. So big picture, it's like a higher rate compared to a 30-year fix, but it's a short-term product because if you sell your home quickly after you buy, then you're paying a high interest rate for a short period of time. That's the most ideal situation. And then the points you pay, you said it's around 2% of the loan balance. And so if you're in a market in which you're looking to buy a home, that is let's just say it's a buyer's market in which buyers have an advantage over home sellers, then potentially you can ask a seller to pay for that cost of that bridge loan because there's a cost inherent in that. And on top of that, it's a much more competitive offer in this scenario compared to an offer that's contingent on you selling and your house is not even listed for sale. So after they buy the house, then what are the options, or what's the next steps for the home buyer?
So the options after they close on their new purchase are that they have up to 12 months to get their house ready to sell. So they have the ability to basically get it prepared. Maybe they got to paint, maybe they got to move things or fix up things, and they get to work with their favorite local real estate professional to get them in that mode. So they have up to 12 months. The big thing to be aware of is that any debt they currently have, any property taxes they have, they will still be making payments on. So we see these on average go for about 90 to 95 days. And so that higher interest rate expense really isn't a big expense. The bigger thing is making sure that everyone's motivated to get to that sale as quickly as possible without giving up any of the value or proceeds. So we do our best to make sure that we're planning ahead so that the client realizes that they got to be proactive in their sale so they don't have a big expense.
Yeah, I think the important thing here is that to have your house ready to be listed for sale, because if you have to do an upgrade to your house, putting new carpets and stuff, and you already bought this house, that just kind of elongates that time period in which you had that high interest rate. So I think that'd be an important thing to consider. And of course, if you're in a market that, buyers have an advantage over sellers, then of course you might have to be a little more aggressive on your asking price as well.
Absolutely. Most people that use this buy before you sell product aren't even really looking for a house, but they've seen their dream home or something came up on their parents' street or in a better school district or closer to work, whatever those things are. So this product allows a consumer or a client to think about moving without having to sign anything to sell their house. So it's no harm, no foul. They don't get in the contract. They don't need to worry about anything on their current property. So that's kind of a balance there of still being able to look and have an optimistic mindset of hey, we can make something happen if we find the right property. Otherwise, we're good staying where we are.
Yeah, absolutely. Because you have people that reach out to me and say, yeah, I want to buy a house, but I haven't seen anything. I've been looking every day for 6 months, but I haven't seen anything. But then they see that, the perfect house, it gets listed for sale in the neighborhood they're looking for, and they have to get kind of scramble. So this is kind of an option for people out there. So that's a bridge loan. Anything more you want to talk about that? Because I know there's
just know we're and also know when you're looking at bridge loans, we've been fortunate to do over $500 million of bridge loans in the last 7 years. I will tell you that going directly with a portfolio lender is the way to go. Portfolio lenders don't have middleman markups, so we're fortunate to have our own portfolio funds for that. But it's just make sure you get a good quote from people and know that it could be cheaper than 2% or could be more expensive. It just depends on your scenario and who you're working with. So that's important.
Absolutely. Yeah, awesome. I'll provide a link below if you guys want more information about this or to schedule a call. So let's talk about option number 2.
Yeah, so option number 2 is really doing a slower process, a traditional 30-day escrow that allows you to buy before you sell. That product we use is called Calq, C-A-L-Q-U-E, Calq, like calculator, spelled in French. What we do basically is use a binding offer on your current property to be able to offset that payment and debt to qualify you on just the debt on the purchase side. What that means is you still have to qualify for any debt you're getting, but it allows you to only qualify for your new home payment. That allows you to have that binding offer that eliminates the ratios of both loans to qualify, which is a government guideline, and you have up to 150 days to replace the offer that is going to be given to you from Calq. That offer normally is not current valuations. Normally it's a convenience fee that's being offered. What I mean by that is that offer normally is like 70 to 80% of the current value. Reason being, we know that the local professional like Jason in Sacramento or somewhere else is going to be better than a national buyer that is really just creating a convenience. They do is they offer a binding offer at less than market that allows that offer to be replaced and allows the client to feel good that they can go work with anyone they want to in the local environment, their local realtor and local lender. What it allows us to do on the buy side is put in financing, for example, a second loan maybe, on their current residence to use as down payment. This option is about half the expense of a bridge loan. Normally the cost on this type of loan is 1% of the offer price on the sale and $2,000, which is a lot cheaper a lot of times than on the other way, which is 2 points with a bridge loan off the higher purchase price value, because most people are moving up in this example. So what we do basically is always qualify someone based upon their ability to repay to make sure that they can afford the updates and afford what they're planning to do in the long run. So we're doing our best to really just keep them top of mind, to let them know, hey, you can do this. If you want to buy before you sell, here's how we do this. It's more systematic and in the traditional 30-day escrow. So if you're competing against other offers, different than a bridge loan that can close in 12 days, these are a little bit less competitive, but maybe you don't need to be as competitive as closing in 12 days. Maybe doing the bridge loan or buy before you sell with Calq is a better solution.
Yeah, I think the important thing is to reach out and we can discuss options, right? Because both have their benefits.
Trade-offs.
Yeah, and trade-offs, right?
Trade-offs. Yep, trade-offs in each one. And we want to make sure that people are comfortable knowing that there are solutions and options that are best for them. And again, each client we work with has a different scenario, which is really cool to think about. So.
Yeah, definitely. So a key thing about Calq is that it's just a tool. They're giving you an offer, but they don't want to buy your house. They're using that because without that, you're saying that the qualification purposes, if you're looking to buy a house, but you already have a loan on you already have a mortgage on your current home, the underwriting standards are going to look at both payments. So the payment of your new house you're going to be buying, but also your current payment, which makes it a little bit more challenging to qualify to buy a new house. So this tool and this kind of like offer is just a way to kind of mitigate your current payment in order for qualification purposes to buy this new house. Is that correct?
Yes, and like you mentioned earlier, Jason, we got to make sure people are A, comfortable with the ability to repay, and B, that they have a good plan, because in any of these scenarios we're talking about, we don't know what their house is going to sell for. We have a ballpark. What happens if Microsoft announces a huge campus down the street? Well, values probably will go higher. What happens if a big employer pulls out of the neighborhood? Might go lower. So what we need to think about is that we have a plan and a backup plan. So being at about a 75% valuation, we should see that in 90 days or 120 days, the market should not move either way by 25% in that time frame. So therefore, we're always qualifying someone at a little higher interest rate than today, because we've seen value rates change dramatically the last couple months. Yeah. So we're always protecting them to make sure that if today's rates are 6%, for example, we're going to qualify them at 7% to make sure that whatever their end loan goals are, we meet them comfortably and that they have solutions that work for them.
That makes sense because, yeah, your end loan, you don't know exactly when it's going to be and who knows what rates are going to be then. So it's crucial to kind of be conservative on those figures for sure.
Yeah, and I can tell you since I've been doing bridge loans, we have not had a single bridge loan go bad. We have not had a single short sale or foreclosure. Every single loan we've done has been paid in full, and there have been no negative ramifications because we're conservative, we're thinking ahead and trying to protect, number one, the client. And that's what's the most important part of what we do here, is protect the client and make sure that they know all the solutions available so that they can make the best decision for themselves. And that's how we look at it.
Yeah, absolutely. I think it's important. I think that I think the whole point of this video is looking at options, right? You have Calq, you have bridge loans, you can write an offer that's contingent on you selling. You could sell your home, rent, and then place an offer. They all have pros and cons, but of course, it's the option or the best option is, of course, your decision, of course, for you watching today's video, everyone watching today's video. But to kind of really go over all those options to figure out what is truly the best solution, though.
And we're lucky to do all those solutions. We're, like I said, a portfolio lender with these products. In addition, I have videos that I've built out that explain this in a 45 to a minute long segments, which are really helpful, not only for the client to understand, but when the offer is presented to the seller and to the listing agent, we also send that video so that people can understand what they're doing. It makes a big difference, because without that explanation, people are like, why would I accept 100% finance offer on my sale, right? Because we go to 100% financing. When we do that, we got to be careful, because it's not 100%. It's a lot lower because we're looking at both properties, but the seller doesn't necessarily understand that. So we're just trying to create education that helps people make good decisions. And again, the right decision is what's the best for you. And sometimes it makes sense to do, sometimes it does not. I've had horror stories where people have sold first and moved into, I think, 11 Airbnbs every week, or people that had animals, they had to displace their animals for months at a time, or do a double or triple move, which is way more expensive with all the costs of labor and fuel today, than just have done a bridge loan or a buy before you sell. Again, everyone has different needs and specific differences to think about. We'd be honored to be a resource for you, and go from there.
Awesome. Yeah, thanks, Jim. Yeah, and this is a little bit confusing of a topic. We're doing our best to kind of explain it. So there's obviously a lot more to it. But if you guys want to reach out to us, I'll provide our contact information in the video description below. But Jim, thank you for joining us today. It's been a little while. And so thank you everyone for watching today's video. Please like and subscribe, and of course, reach out if you want more additional information about how do you actually sell before you, or how do you actually buy before you sell your house. With that said, I appreciate you guys for watching today's video. Please like and subscribe, and we'll see you in the next video.